Hi, I'm Darryl Mullis from Stratactics. Our company is in Boulder, Colorado, and I'm going to talk to you today about the purpose and the relationship of the three financial statements. I'm going to do this here on the flip chart. And the first thing I think you need to know when you want to understand a company is that companies in the end only consist of four things. The first one is cash. The second, property. The third is contracts. And of course the fourth is you, people. And of course people manage cash, property, and contracts. And one of the problems companies have is that most people are not quite clear what the relationships are between these three things, and so they're not quite clear how their day-to-day decisions impact performance at their company. So cash, each one of these three is associated with one of the financial statements. Cash, of course, is measured and associated with the cash statement. And there are three types of cash flow that you have to manage. What's called OCF, operating cash flow, ICF, which is investing cash flow, and FCF, which is financing cash flow. Property is associated with the financial statement called the balance sheet. Now, balance sheet, as most of you probably know, has assets on the left side. Besides cash, things like accounts receivable, inventory, fixed assets. On the right side, there are two things. One is called liabilities, which is all the people that are provided assets to the company that have not yet been paid, that we owe money to. Finally, the right side on the bottom is called OE, owner's equity, which means the total number of assets that are owned by the owners of the company, free and clear of any liabilities or debt. The third aspect of a business is contracts, which is represented by the income statement. You might think of these as the promises and agreements that your company has made with its customers. And essentially the income statement represents the contracts where we've completed our agreement with a customer. The way that's talked about is that when we complete a contract with a customer, we have what's called revenue. And of course, the income statement shows us how well we've managed that revenue. We have to subtract the cost of sales from it, which gives us an interesting number called the gross profit. Now, this is called the gross profit because we have to subtract one other thing from it, which are our general and administrative expenses. We'll just call those expenses. When you subtract that, we get what's called a net income. So, cash, property, contracts. Now, for every company, what is it trying to do? It's trying to take these assets or these resources and turn them, use these assets or resources to create revenue with customers. Now, once revenue is created, Our purpose is to manage our costs as effectively as possible to turn that revenue into net income. And finally, what do we want to do with net income? You can see net income is black, not green, which means it's just a concept. It's not really money yet. So our purpose is to turn that net income into cash as quickly as possible. So that's a quick overview of the 3 financial statements, their purpose and relationships. Thanks so much.